Good evening, ladies and gentlemen. It's a great pleasure to be here this evening, but I have a problem. And the problem is this. This is the written version of the lecture. It has gone up on the website a few minutes ago. It is 19,600 words long at a pace of 125 words per minute. That will take me 2 hours and 36 minutes to deliver. Now, I know that there are several of you here who were looking forward to a lecture of that length. You brought along your packed sandwiches and probably your sleeping bags as well. But some other of you probably want to get away a little bit earlier. So what I'm going to have to do this evening is not talk to the written text, but talk from some of the slides and try to give you the key elements of the argument that I'm putting forward. But inevitably that means that there are various points where I'm simply going to assert an argument. And if you find it unconvincing, my answer is simply going to be, well, go and read the full written text. But hopefully this will at least give us enough to debate on my propositions. Now, it's 5.5 years since the financial crisis began, and it's 4.5 years since the intensification of that financial crisis in autumn 2008. And it was clear right from autumn 2008 that there was going to be a big financial impact of that crisis. But at the time, and into 2009, nobody in the official sector foresaw what a big impact that financial crisis would have. If you look at the forecast produced by the Treasury, the Bank of England, the IMF, the OECD, or whoever in early 2009, all of them suggested a far faster pace of recovery across the developed world than that which has actually occurred. The problem of this, what is sometimes called Great Recession, has been larger than we anticipated. And I think that reflected our failure to understand just how deep was the impact of deleveraging after a financial crisis, and that reflected an intellectual failure in our understanding of the links between financial stability and macroeconomics. And it's essentially about those links between issues of financial stability and issues of macroeconomic demand management that I want to speak this evening. The situation today in the UK is that we are now about 12% or so below the trend rate of growth where we would have been if we'd continued on 2007 direction. And we are unlikely to get back to the 2007 level of GDP per capita until either 2016 or maybe 2017 or maybe 2018. So in terms of lost growth in prosperity, this is undoubtedly a lost decade. And we therefore need to think very carefully, fundamentally, about what went wrong, and we need to be adequately radical in our redesign of the financial system to make sure it doesn't happen again. But we also need to think creatively about the combinations of policies needed to navigate against the deflationary headwinds created by deleveraging. In the field of macro demand management, that context suggests two questions that we now need to address. First, do we need new targets of macroeconomic policy? And secondly, do we need new tools? Before the crisis, there was a very strong consensus developed that the appropriate target of macroeconomic policy, expressed through central bank mandates, should be a low, positive and symmetric inflation rate target. That was the consensus to which the world had migrated. But now there is a raging debate about inflation rates versus price levels, about nominal GDP or nominal growth rates, about higher rates of inflation. And those are important issues that I'm going to touch upon. But I'm also going to suggest that although the issue of targets is an important one, the issue of tools is even more important, because I think we could set targets, different targets like nominal GDP targets, and still find it difficult to meet them or only meet them through the use of tools that had adverse side effects. So I think we also need to think about the tools by which we stimulate aggregate monetary demand. There are monetary tools, macroprudential tools. Some would argue you can use fiscal tools, you can use interest rates, QE, or credit easing. And at the extreme end of the spectrum of the possibilities of the tools you can use is helicopter money, overt money finance of fiscal deficits. And I'm going to urge that the possibility of OMF, as I call it, overt money finance, should be taken out of what I call the taboo box. We should be allowed to talk about it. And I believe that for three reasons. First of all, because I think intellectual clarity is important. I think it's important for us to have debates where we have no taboos and we debate the pros and cons of different options. Because even if you then reject one option, that very process of exploring its pros and cons will inform how you use other options as well. Second, however, I think there are some circumstances, they may be extreme circumstances, where you should use helicopter money, overt money finance. And thirdly, I think we may well end up at the end of this deflationary process using that tool, and we would be better to debate it earlier, because if we debate it earlier, we are more likely to use it within tight and appropriate disciplines rather than to use it excessively and under the pressure of short-term political events. But even to mention the possibility of overt money finance is to break a sort of taboo, because printing money to support fiscal deficits is seen as something which is not only technically undesirable, but a sort of moral sin, a sort of unclean thing to talk about, a work of the devil, indeed. In September last year, Jens Weidmann, president of the Bundesbank, gave a lecture in which he quoted from Goethe's Faust, Part 2. In Goethe's Faust, Part 2, Mephistopheles, as the agent of the devil, tempts the emperor. He says to the emperor, "You own the gold and silver under the ground. We don't need to dig it up. You can just issue paper receipts to that gold that we know exists." And this produces a boom in the economy. But according to Jens, all this activity eventually degenerates into inflation, destroying the monetary system because the money rapidly loses its value. So it seems that to some, money creation is a work of the devil, and one has to work out whether Jens had Mario Draghi in mind when he talked of Mephistopheles, but he was certainly concerned. And actually there are very good reasons to be fearful of money finance. Because once you no longer have a commodity money, a money based on gold and silver, once you move to a fiat money, money is simply what the state says money is. It is the fiat of the state. And if so, it can be created in limitless amounts. And if created in too much amounts, in limitless amounts, it will produce hyperinflation. And it wasn't some hardline monetarist, it was in fact John Maynard Keynes who said that there is no surer means of overturning the existing basis of society than to debauch the currency. But before we decide on that basis that we should dismiss this idea out of hand, I'd like you to consider a paradox from the history of economic thought. Milton Friedman is rightly seen as one of the founders of the Chicago School of Free Market Economics, and a person devoted in much of his writing to thinking through what were the mechanisms that would assure monetary stability, low inflation. But Milton Friedman, in 1948, proposed that not only should we sometimes use money to finance fiscal deficits, he actually argued that we should always use money to finance fiscal deficits, and that this would be a surer, sounder basis for economic stability than what he saw as the rigmarole of first issuing interest-bearing securities and then having the central bank buy them in open market operations, which by then had developed. And Friedman was not alone in that. He was in the same company of people like Henry Simons and Irving Fisher, who had arrived at the same conclusion. And indeed, I think it's interesting to note that recognition that pure money finance is the ultimate answer to extreme deflationary changes is a point of convergence between Keynes and Friedman. Friedman talked about helicopter money, printing money and scattering it on the ground so people could pick it up gratis. Keynes wanted people to at least have to work to dig it up. He talked about pound notes in old bottles buried in disused coal mines. This is slightly odd because John Maynard Keynes was not known as a Puritan, that he insisted on this work. But both of them were basically arguing that there are extreme situations where you should simply create money and get it into what Friedman called the income stream. And Ben Bernanke, and I will return to this later, in 2003, Ben Bernanke, the current chairman of the Federal Reserve, quite clearly argued that what Japan should do is an overtly money-financed tax cut. So when you have economists of the caliber of Henry Simons and Irving Fisher and Milton Friedman and John Maynard Keynes and Ben Bernanke all suggesting that there are some circumstances in which this is an appropriate option, it would be a bit odd if we put it in the taboo box. So I am going to talk today, later in the lecture, about that as an option. But it's not the sole purpose of what I want to talk to today about. I want to talk also about essential links between financial stability and issues to do with leverage and the structure of financial markets and with issues of monetary economics, a connection which we largely moved away from and ignored in the period before the crisis. And I'm going to do that in 8 sections and then 2 final bits. First of all, I'm going to suggest a framework for thinking about the relationship between macro demand policy levers and their effects. Secondly, I'm going to run you through what Friedman said in 1948. Third, I'm going to talk about the absolutely essential role of leveraging and deleveraging on an economy. Then, with that as background, I will raise this question of what are the appropriate targets. Are they prices or nominal GDP? Are they rates or levels? And then I will deal with 3 sets, not of targets, but of tools. Conventional and unconventional monetary tools, potential limits to their effectiveness, and potential adverse effects. I'll talk about fiscal tools, their limitations and risks, and then I'll get to overt money finance, the definition and its advantages, dangers and constraints, and how we can make it compatible with the discipline of central bank independence. I'll then set out, though it's not my main purpose today, some possible implications of what this might mean for actual policy in Japan, the US, the Eurozone, and the UK. And then I'll finish by summarising the conclusions and take us back to some reflections on Mephistopheles, money, and debt. So, sorry, am I talking without my thing on? Oh, well, you seem to have heard me so far. Right, let's start with the framework. This tries to set out a rigorous way of thinking about the relationship between policy levers and effects. On the left-hand side, there are 4 categories of things that could influence aggregate nominal demand. You could have fiscal policy, surpluses, or deficits. You can have monetary policy, the setting of interest rates, classic quantitative easing, forward guidance on future interest rates. You can have central bank private credit support, such as the bank's funding for lending scheme, or you can move macroprudential levers like relaxing or tightening bank capital and liquidity. All of those would in different ways impact on the level of aggregate nominal demand. Now, I don't think that 4-fold division is definitive. We could categorize them and split them up in different ways, but I think that pretty much covers the universe of ways that you could try to stimulate aggregate nominal demand, provided we add one other, which is OMF or OPMF, overt permanent money finance, which, as I'll explain later, really is a merger and a combination of the fiscal and the monetary box. So those together influence aggregate nominal demand. And on the right-hand side, aggregate nominal demand must be expressed either in prices or real output, and an increase in aggregate nominal demand and an increase in prices or an increase in real output. And that suggests 2 questions. First, how relatively effective are the levers in the left-hand side in influencing aggregate nominal demand? and what adverse side effects might those different levers have? And second, what can we say on the right-hand side about how aggregate nominal demand increases are likely to end up in either prices or output? And one crucial thing in answering those questions I'm going to assume to start with, though we can then relax assumption, is what I call independence, that those two issues of how you influence aggregate nominal demand and how it's split are independent questions. Thus, I will suggest that the division of aggregate nominal demand between a price effect and a real output effect will essentially be determined by some real factors to do with spare capacity in labour or physical markets, or the flexibility of price-setting processes in labour or product markets, and that therefore that division will be independent of the specific lever that you pulled in the first place in order to increase aggregate nominal demand. Now, of course, you could challenge that proposition of independence. And let me suggest two ways in which that independence hypothesis might not pertain. You could have an expectational channel where if you acted in a way that produced expectations that you would act in an inflationary way in future, you might produce expectations of inflation, which would itself bias the division towards the price side. Secondly, maybe we think we're clever enough to either pull a fiscal policy lever or a credit support lever in a way that would directly help produce an increase in supply capacity. Well, if we were clever enough to do that, we might be able to bias the result towards a real output rather than a price effect. But I think it's very useful to start with the discipline of assuming, of asking what the world is like if you assume independence, because I think most of our debates in this area are bedeviled by people not making it clear what they're assuming here. So you will get people who strongly assert we've got to do X, like issue more credit, have more bank lending in order to get the economy going, implicitly assuming that that's going to have a real output effect, not inflation, but who will tell you you mustn't increase the fiscal deficit or you mustn't do something else, you mustn't print money, because that'll be inflationary, implicitly assuming that all of the aggregate nominal demand is going to go into prices, not output. We have got to be rigorous about what one's assuming about independence or not to think straight on this issue. So that's my framework. Now let me turn to Milton Friedman, 1948. In 1948, Milton Friedman wrote an article, and it has a very interesting title, A Monetary and Fiscal Framework for Economic Stability. Right? So he was arguing that what he was suggesting was a good basis to have stability. And what he clearly said was that he wanted to use automatic adjustments to the current income stream, an interesting phrase to which I'll come back later, to offset changes in other segments of aggregate demand and to change appropriately the supply of money. Under the proposal, government expenditures would be financed entirely by tax revenues or the creation of money, i.e. fiscal deficits would be covered entirely by the creation of money. That is the issue of non-interest-bearing securities. The chief function of the monetary authority would be the creation of money to meet government deficits. Now that is a statement which would give most central bankers an absolute heart attack. The chief function of the monetary authority is the creation of money to meet government deficits. This is a very strong assertion. So what really was Milton Friedman saying? Well, I think this exhibit illustrates, these are my figures rather than his, but it illustrates the essence of what he was saying. Suppose you had nominal GDP at 100 units and you had a starting point money supply of 50. Suppose it was a sensible aim to grow nominal GDP at 4% per annum, and you thought maybe that might divide into 2% real growth and 2% inflation. Then the equilibrium money supply growth might be around 4%, if we assume constant velocity of circulation, in which case the appropriate increase in the money supply is achieved by running a fiscal deficit of 2% of GDP financed entirely by money. That's because running that deficit and financing it by money will increase the money supply by 2 units, which 2 over 50 is 4%. So that's what he was saying, and that's what Henry Simons was saying. That's what Irving Fisher was saying. Now, interestingly, in that illustration and in Friedman's initial article, as indeed in the work of Simons and Irving Fisher, there are two simplifying assumptions, one of which is not fundamental, the second one is. The one which is not fundamental is that there is a stable relationship between money supply and money GDP. There's a constant velocity, so that delta GDP relationship with delta money is the same as, is constant over time. That's not fundamental to the proposition because obviously the velocity of circulation of money does change over time, but you could say I'm still going to follow the policy that Friedman suggested. I'm just going to observe empirically over time how that is evolving and adjust the deficits that I run and money finance in the light of that. The far more fundamental assumption was that all money is base money. There are no fractional reserve banks in this world. There is no private money creation. And that wasn't just something sort of assumed to make the maths easier. That was an explicit aim of what Friedman, Simons, Fisher were talking about. So Friedman was talking about here a reform of the monetary and banking system to eliminate the private creation or destruction of money. Now, just so everybody's clear what you mean by fractional reserve banking, in a fractional reserve banking system, you have a central bank which issues notes and coins. It has some central bank reserves which are held as reserves by the commercial banks, but the commercial banks can run deposits which are a very big multiple of reserves. And it's called a fractional reserve banking system because this is a small fraction of that. In that system, deposit money is a multiple of reserves at the central bank, and the total money supply, which is notes and coins plus bank deposits, is a multiple of base money. There is a money multiplier in the system. In a 100% reserve banking system, commercial banks are not allowed to do fractional reserve bankings. For every deposit they have to hold a reserve at the central bank. In that system, deposit money equals reserves at the central bank, and total money supply equals base money. The only money that exists is the fiat liability of the central bank. Now, why did Friedman think like that? Well, he and Simons and Fisher had developed their thinking in the face of what had happened to the American economy from 1929 to 33. And they had come to the conclusion that the fundamental thing that had gone wrong was that the authorities had allowed private banks to create private credit and money, and that they shouldn't have done this. That this was an element of free markets that shouldn't exist. They believed that there had been an excess leverage boom in the 1920s, and that this had come to a crisis, and they believed that at the core of that lay the ability of fractional reserve banks simultaneously to create money and credit. And this is very important because we often talk about banks as if what they do is take pre-existing money and intermediate it into a loan to somebody. They don't. Banks create credit and money. That is absolutely fundamental to understanding the way the monetary system works. So Henry Simons believed that this was totally unstable. He said, in the very nature of the system, banks will flood the economy with money substitutes during booms and precipitate futile effects at general liquidation thereafter. And he then argued that private initiative has been allowed too much freedom in determining the character of our financial structure and in directing changes in the quantity of money and money substitutes, which gives us a second paradox on the history of economic thought. Henry Simons is a foundation father figure of the Chicago School of Free Market Economics. But Henry Simons believed that financial markets in general, and fractional reserve banking in particular, were such special cases within markets that he was proposing not just that they should be regulated heavily, but that they should be effectively regulated out of existence. Indeed, Simons went further. Simons really hankered after an economy where there weren't any debt contracts at all. because like other important mid-20th century economists, he realized that if you could have an economy entirely made up of equity contracts rather than debt contracts, it would be a smoother functioning economy, which would not go through the cycles of upswing and downswing which an economy with debt contracts may tend to have. Now, the question therefore arises is whether we agree with Simons and Fisher and early Friedman, should we abolish fractional reserve banking? I have enough arguments with our banks about our proposal to increase the capital ratios from sort of 4% to 7%. I think I might not be all that popular if I now said, well, I've decided that 100% would be about the right figure. And in fact, I present in the written document, but I'm not going to go through it now, and I presented in more detail in a lecture which I there reference, which I gave in South Africa and in November, a set of arguments as to why fractional reserve banks are value creative. And those arguments go back to people like Walter Bagehot. So I am not in the camp of saying we should get rid of fractional reserve banks. But I do think we should take from Friedman, Fisher, Simons the insight that there are some very close links here between these issues of financial stability and monetary economics. And we should also take from them that even if we believe there is a value creative function in fractional reserve banks, the fraction didn't need to be anything like as small as we allowed it to become before 1929 and as we then allowed it to become before the latest crisis. There are therefore two lost insights, I think, of early free market economists. First, that banking is special. Arguments for laissez-faire in other sectors of the economy are not applicable here. Secondly, monetary and financial stability are very closely interlinked. Let me turn to my third section, which is, I'll try and be brief on this, financial stability and macro demand management, why they're linked, and the crucial role of leverage. Again, in the interest of time, I'm simply going to assert the key points of this argument, and you'll have to look at the main lecture text to understand it. But the essence of the argument goes like this. As those early economists pointed out, and as others have pointed out, debt contracts create the potential for financial fragility in an economy. And that's because there are at least three features of debt contracts which are different from equity contracts. First, they create some specific risks, such as the risks that arise from bankruptcy and default. Ben Bernanke, in one of his essays on the Great Depression, points out that in a fully complete markets world, we would never observe bankruptcy. Bankruptcy sort of doesn't occur in total free markets, in total complete markets, as described by theoreticians of market economies, because everything is a smoothly changing contract before you get to bankruptcy. Actually, bankruptcy does exist, and it creates default events, it creates fire sales, it creates self-reinforcing cycles. Secondly, there's something about debt contracts that fool people. Debt contracts always have a probability distribution of potential results. There is a potential loss as well as getting your money back. But there's something about them where in the upswing, people assume that these things are risk-free. And they assume that they're risk-free until the point where they suddenly assume they're not risk-free, and then they panic and react. And that's very different from holding an equity contract, where it's pretty obvious every day that this thing can go up or down. There's a problem in debt contracts that you're not getting a continual feedback of information that tells you there's a negative as well as a positive. So that's something about debt contracts. The second point is that unregulated bank credit and private money creation is inherently unstable. I think I'm just going to have to assert that for now, but the argument is in there. It has been made by many people. There are tendencies within the process of bank credit and money creation for it to be excessive on the upswing and then liquidated on the downswing. And thirdly, these swings, these pro-cyclical swings, which are behind credit cycles, they become even worse when you lend money against real assets which go up in value. Behind every banking crisis for the last 100 years is lunatic lending to commercial real estate. Basically, people lend money to commercial real estate prices go up. Everybody thinks that proves how clever I was to lend money against commercial real estate. Everybody who borrowed money says that proves how clever I was to borrow money about commercial real estate. So they all go round and they lend and borrow some more money. And these pro-cyclical cycles in credit and asset prices, very well described by Hyman Minsky, I think are fundamental for us understanding how the economy works. What all of that means is that real economy leverage, credit creation dynamics, and credit asset price cycles are absolutely crucial macroeconomic phenomenon. They have macroeconomic effects. In which case we should be rather interested that they've gone up in amount. Look at this measure of leverage in the UK. US debt as a percentage of GDP by corporates, by households, and by the financial sector internal within itself. Look at these extraordinary variations over the course of the 20th century. This economy is bound to be a very different economy from that economy in terms of its fragility, its vulnerability to crisis and what happens after crisis. Or to give you just a few more figures from the UK, this is UK corporate lending over the 50 years from 1964 as a percent of GDP, from 12% of GDP, and this is just the bank bit, back in 1964 to 35% at the crisis. And note that the credit bit goes up, but so does the money bit. Money and credit are just two sides of a bank balance sheet. They're bound to go up together, and we see the same in household deposits. Household deposits going up as a percent of GDP, household lending as a percent of GDP going up even more so. So we know from theory that the level of leverage in the economy, the amount of debt contracts relative to the amount of equity contracts, can make the economy more fragile. And we know that the amount of these contracts, the total leverage in the economy, has hugely increased. It's gone up, orders of magnitude in the last 50 years. We're running a very different economy. But what's interesting is that in the pre-crisis period, those trends were largely ignored by macroeconomics. Macroeconomics really paid very, very little attention to what went on in the guts of the financial system. We sort of assumed that we could ignore the plumbing of the financial system. And indeed, broadly speaking, the attitude towards this increase in leverage was that it was either neutral and could be ignored, or that it was welcome. It was neutral because it simply had no effect on macro demand and the macroeconomy, or it was welcome axiomatically, because, of course, these are the products of free contracts between free contracting parties, and if you believe axiomatically in market perfection, or in then the only free contracts that people will be sensible free market contracts. And broadly speaking, that was the attitude to this increasing leverage. But increasingly, since the crisis, I think people have been focusing both on the theory of why leverage can cause problems and also on the empirics. And this is the result of a very interesting study produced by the Bank for International Settlements last year. The chief economist of that, Steve Cicchetti, with a colleague of his, producing an analysis which suggests that the relationship between economic growth and the level of leverage in the economy follows a sort of inverse U. That up to a certain point, increasing credit, financial deepening, is positive for growth, but you go beyond a certain level and it becomes negative both for the volatility of growth and for the actual sustained rate of growth. And similar conclusions are produced, for instance, by Maurice Schillerick and Alan Taylor in some very fine articles. I believe the implication is that we have to think about the aggregate level of leverage in the economy as a crucial macro variable on which macroprudential authorities and monetary authorities have to have a point of view and have to focus. And we didn't do that before the crisis. However, the main thing I want to talk about this evening, it is this morning already, this evening, is not the upswing, the leveraging stage, and how we avoid that in future, because we can worry about that in 15 or 20 years' time. It's the stage that we're in at the moment. Because the trouble when you have too much leverage is you reach a crisis, and then you go into a deleveraging phase. And that is where we are at the moment, with credit growth collapsed. If we look at long-term credit growth to UK business, you can see that it was, broadly speaking, positive almost every year and running at 15% or so all the way for the last 50 years, apart from a couple of years in the early 1990s. But now we're into a sustained period of very significantly negative credit growth. Similarly, in the area of households, shorter time series here in 1994, but we've gone from a period of rapid credit growth to a period of very low credit growth. And the problem that creates is that what we have is an attempt of households and corporates to delever, to get their balance sheets back in balance, but that is itself depressive to asset prices and nominal demand, and therefore to activity and income, in a way that can make it very difficult for those households and corporates actually to achieve deleveraging, because the denominator of nominal income is moving away, downwards away from them at the very time where they try and reduce their nominal debt. I think this attempted deleveraging is fundamental to the stage in which we now find ourselves. Irving Fisher certainly believes so. A wonderful classic article of the economic literature, Irving Fisher's Debt and Deflation, provides an explanation of why a deleveraging cycle was fundamental to what turned the financial crisis of 1929 into the Great Depression thereafter. And this deleveraging process has, I think, been brilliantly explored in relation to Japan by Richard Koo in a book called The Holy Grail of Macroeconomics. Koo's argument is that if you want to understand Japan in the 1990s and 2000s, you have to have a concept which he calls a balance sheet recession. And a balance sheet recession is one where corporates, and in Japan it was particularly corporates rather than households, are fundamentally focused on getting their balance sheets back in order, reducing their leverage, almost whatever you do to the interest rate. So that, faced with the beginning of a depression in the early 1990s in Japan, the Bank of Japan reduces the interest rate down effectively to zero by the mid-1990s. But what happens to credit, supply and demand? Nothing. The reduction in the interest rate basically has almost no effect because people are trying to delever their balance sheets at almost any cost. In this environment, Koo argues, the only thing that stopped Japan having a recession was the willingness of the Japanese government to run large fiscal deficits. Now, of course, those fiscal deficits naturally arise because of the recession, because tax revenues goes down and some expenditures go up. But Koo also argues that what you have in the move of the government into a, and I think we've got this the wrong way around here, sectoral deficits and surpluses as a percent of GDP. This is the government, and this is the PNFCs. Switch your blues and your greens, please. As the corporate sector switched from borrowing tons of money in the 1980s to saving lots of money in the 1990s, the only thing that kept the economy moving was the willingness of the government to run large public deficits. But the problem with that is that the inevitable consequence of those rising deficits is rising public debt. And the trouble with that is that it means that total economy leverage, public and private together, doesn't go down. It just shifts from the private to the public sector. That is what has happened in Japan in the last 20 years. A gradual reduction in a non-financial leverage, and here we've got our reds and the blues the right way around, but a continual increase in general government debt as a percent of GDP. And that is exactly what is now happening and has been happening for the last 4 years in the UK the US or Spain, where for every percentage point that the private sector, and we've got here household and corporate, manages to delever, the public sector adds more leverage. I think this is fundamental. This creates some fundamental challenges. It is a product of the excess leverage that we allowed to develop before the crisis, but it creates an incredibly difficult macroeconomic environment, an era of deflationary headwinds, attempted deleveraging, but with deleveraging not actually successful, but the leverage simply shifting from the private to the public sector. And I think it's that context of deleveraging after a crisis within which we have to answer the two questions that I suggested earlier. First, do we need more new targets of macro demand policy? And secondly, do we need new tools? To begin then on targets, before the crisis, very strong consensus, conventional wisdom, that the target should be price stability, and that price stability, most central banks thought, best expressed as low but stable inflation, say 2%, and a symmetric target, stop it going above 3, stop it going below 1. Now, however, we have a debate all over the place. There are people suggesting alternative inflation measures which exclude one-off tax or commodity price effects. There are people arguing for a higher inflation rate permanently or over a period of time. Olivier Blanchard and some colleagues at least floated that idea, Olivier, chief economist of the IMF, in an article 2 years ago. We have debates about whether we should provide guidance, forward guidance, that implies that policy will remain loose even after inflation rates go back on target. And we have people arguing that we should focus on the price level trend, return to where we would have been on inflation rather than the inflation rate looking forward at any one time. And then there are also people suggesting that we should think about price or real output-focused measures. Should we have circumstance-contingent future guidance? I will maintain loose policy until unemployment goes below X%. That is what essentially the Federal Reserve moved to in autumn 2012. Some people arguing for money GDP growth rates as permanent rule or temporarily. Michael Woodford, very interesting person in this respect because he is the author of one of the great canonical works of recent monetary policy orthodoxy, Prices and Interest, suggesting that we should actually seek to return to the money GDP level trend we were on before 2007. Mark Carney, in a speech called Guidance in December 2012, raising issues, not coming down on any one of those sides, but saying those are all very interesting issues that all need now to be thought about. So, very briefly, and I'm going to keep this bit brief because I want to get on to tools, what can we say about that debate? I think there are basically three arguments for why we might make a major rather than a minor change in targets. The first would say, look, we just have a high potential for non-inflationary growth. You say, look, the economies are all short of capacity, therefore there's quite a wide range of real output increase which won't make much difference to inflation. Though note that you could pursue that without actually changing the inflation target. You could simply say that the central bank should have the objective function, be interested in stimulating growth, subject to at least hitting your inflation target. You don't need to change the target to take that into account. And essentially, that is what the Federal Reserve does already, and indeed, to a degree, it is in the Federal Reserve's formal statutory target. The second argument is that you use inflation to erode excess debt levels with higher inflation. And this is what Olivier Blanchard and colleagues were hinting at in 2010, and it's also where pretty much Kenneth Rogoff, a former IMF a chief economist, has been in several of his writings. And there is a reasonable argument that we are going to find it incredibly difficult to achieve deleveraging of the public sector without either a higher rate of inflation or at least a higher rate of nominal GDP than we have at the moment. I mean, it's certainly the case that if you ask how on earth did Britain get down from 250% debt to GDP at the end of the Second World War or the US from about 120% debt from GDP at the end of the Second World War in the big swing of public sector deleveraging that went over the subsequent 30 years, the answer is that they were then achieving rates of growth of nominal GDP which were much faster than present levels. And without rates of growth of nominal GDP of 6, 7, 8%, it's difficult to see how they would have ever achieved that public sector deleveraging. So there is an argument there, but it's also an argument that we have to be very careful of. I think if we start running 4 or 5 or 6% inflation rates, we really are in danger of what we call de-anchoring inflationary expectations. We don't really know what is the level of inflation which becomes accelerating rather than higher, but I think it is in the danger zone. And it's also the case that whereas you can get rid of the burden of some existing debt by having a higher rate of inflation, which is that debt which has a long-term fixed interest rate, if it's variable rate debt, increasing the higher rate of inflation is probably just going to go through to the interest rate and isn't going to get you out of the debt trap. So I'm a bit wary of that one. The third argument is a very complicated argument, but I think actually the most compelling, which is that you need forward commitments of future accommodative policy. The essence of the argument here is that actually the movement of the bank rate isn't primarily important because what it does to the cost of borrowing today. It's important because of the expectations it produces of the cost of borrowing in nominal and real terms over the next 5 or 10 years. But the argument then goes, when you're at the zero bound and you can't reduce current interest rates, you'll only be stimulative enough for the economy if there's a strong expectation that that zero bound is going to exist. Those close to zero interest rates are going to exist into the future. And you'll only stimulate the economy if people expect that stimulation. But that if you have a bank, a central bank, which in 3 years' time will set the inflation rate, the interest rate then, on the basis of a purely forward-looking inflation target at that time, taking no account of history, then a reasonable person would expect it then to be tightening policy in a way which means that you'll never get the recovery. It's almost as if we get locked in a sort of catch-22 expectational trap. And therefore you have Mark Carney, for instance, suggesting that a central bank may need to commit credibly to maintain highly accommodative policy even after the economy or inflation has picked up, and that to make that a credible commitment, you somewhat have to tie your hands by committing not just to an inflation target looking forward at any one time, but to restore a certain level of the inflation rate, the price level, or linking yourself to nominal GDP. So what do I actually think at the end of this? Well, I think the potential for non-inflationary growth, that's a reasonable argument. The erosion of debt via inflation, higher inflation, may be an argument, but I'm a little bit queasy about it. The forward commitments to accommodative policy, I find that pretty compelling. I think there is at least therefore a reasonable case for considering the alternatives. But I also argue in the full paper that these should be temporary, not permanent regime changes. And I find particular attractions in either circumstance-contingent pre-commitment, such as the Federal Reserve policy, or taking account of some target nominal GDP level, but not as high a level as Michael Woodward's suggestion of a return to the pre-crisis trend. But I want to stress that although that's what I'm saying on that issue of targets, I actually think this issue of targets is probably less important than the issue of tools. Because I think we could set a new target, like we're going to get to a level of nominal GDP 10% higher in 2 years' time or something like that, and still have a problem of what tools are we going to use to get there, and do we have tools which will get us there without offsetting adverse effects? So I'd like to run us through 3 categories of tools. The first are the tools, all of which exist in these 3 boxes: monetary policy, central bank private credit support, macro-prudential policy. Are these tools in these boxes adequate to stimulate aggregate nominal demand to the extent that we want? The primary tool here is clearly interest rates. But the trouble is we've already reduced interest rates to the zero bound or close to in most cases. But the good news is that beyond the zero bound of interest rate, we have a whole number of other tools in those boxes. We can do standard quantitative easing, buying government bonds. You could do, as Ben Bernanke argued in 2000 in relation to Japan, quantitative easing focused on all sorts of other assets, private bonds, equity, property, foreign exchange. You can do liquidity support like the ECB LTRO operations. You can do direct credit subsidy like the FLS, or you can vary macroprudential policies such as capital and liquidity requirements. And indeed, central banks have been busy doing all sorts of variants of those policies, so that all of the major central banks, the size of their balance sheets as percent of GDP has gone from typically in the 5, 10 region to 30, 35, 20 or so over the last 5 years. And this is central banks moving beyond the reduction of interest rates into a whole load of other policy levers. And best available empirical estimates do suggest that some of these other policy levers makes a difference. The Bank of England's analysis in its own quarterly bulletin of the third quarter of 2011 argued, and I think it's as good as you get in empirical analysis, that the quantitative easing that the bank had done up until then had probably, best estimate, produced an increase in the price level about 0.75% to 1.5% above what it would otherwise have been, and an increase in the level of real output to something like 1.5% to 2% above what it would otherwise have been. And I have no reason to question those. I think that's the best empirical estimates that we've got. But I do think that even if we accept that as the impact of these measures so far, we should be worried about two things. First, whether there are limits to the effectiveness of this category of measures, and second, whether they bring with them adverse side effects. The limits would arise because, let's be clear, all of these levers that we're talking about in monetary policy, credit supply, macro-pru levers, they all work through indirect channels. None of them are giving you, some money to go out and spend. They're reducing interest rates, buying a bond off you, which then produces on your part a search for yield, a move in what people who think about asset portfolio allocation call a move in their preferred habitat of where people want to invest their money, and that then produces asset and wealth effects, and then people start spending money. And the trouble is that if you believe, like Richard Koo, that there's this phenomenon of a balance sheet recession, then all of these are still working through the interest rate, and you still look at the lower interest rate. It's now a long-term interest rate as well as a short-term interest rate, and you say, thank you very much, I'm still not going to borrow any money. So they may not stimulate as much as you think. And as for switching somebody who owns a bond for money, once the long-term interest rate is also getting close to zero, as it is in Japan, as well as the short-term interest rate, taking a bond off you and giving you money isn't changing much. These are very close substitutes at that point, and you're not going to change your behavior. So it may well be that all this package of measures reaches some limitation. And equally, the more you do of it, the more there may be some adverse side effects. Relying just on these policies clearly has committed ourselves to low interest rates for many years. Maybe more than a decade or so. I think we may be in this trap for a long period of time. And although it's difficult to work out, if we maintain low interest rates, close to zero interest rates for a long period of time, out there somewhere in the financial system, there's going to be all sorts of fancy, speculative carry trades off the basis of those low interest rates, creating financial stability risks which we will find very difficult to see in advance. And if these policy levers work, what they're doing is re-stimulating private leverage. But if it's excess leverage that got us into trouble in the first place, I think we should be a little bit wary of solutions that rely on, as it were, the hair of the dog that bit us. Relaxing prudential standards, reducing capital or liquidity requirements, as we effectively did in association with the funding for lending scheme last July, is inevitably creating financial stability risks. It's accepting slightly less capitalized or less liquid banks. And, as has been mentioned by many in the emerging markets, the more countries in the developed world are using these quantitative easing schemes, part of the transmission of mechanism might be a lower exchange rate, the more that's creating complicated spillover effects in Brazil or China or other countries which are having to deal with the potential pressure of rising exchange rates. Now, let me be absolutely clear. That doesn't mean I disagree with the policy stance which we have in the UK at the moment. I'm not on the Monetary Policy Committee, but if I had been, I would have voted to bring bank rate down to 0.5% and leave it there. And I would have voted for the quantitative easing programs. I am on the Financial Policy Committee, and I supported the changes, the relaxations in our liquidity and capital standards last year, and I supported the expression of support from the FPC to the banks funding for lending schemes. I think these are policies which we need to use if we don't have other policy tools, but I think we shouldn't fool ourselves that they don't have potential disadvantages. And therefore, I think we also need to think about whether there are other tools which don't have those disadvantages. Now, one of those other tools could, of course, be funded fiscal stimulus, just a classic fiscal stimulus, and you spend more than you get in as tax revenue, you borrow the money to cover it, but it stimulates the economy, you could say, because it directly gives somebody a tax cut or a public expenditure increase. It puts money directly into what Milton Friedman called the income stream. But the conventional wisdom of the pre-crisis era, and I think this is right, is that in most normal times, that beneficial stimulative effect, if you need it at that time, of a funded fiscal deficit is offset by two effects, one of which is a crowding out effect. You increase the interest rate and some other category of a private expenditure is crowded out. And the other, a Ricardian equivalence effect, which is the individuals know that you're piling up debt that they'll have to pay back in the future, and they're clever enough to think that they better save something to deal with the future tax burden that they'll have to bear to pay it back. The conventional wisdom of the last 20 years, and I'm not challenging it, has been that in normal times, funded fiscal deficits are not a very useful stabilization tool. But while that is true in normal times, Brad DeLong and Larry Summers, I think, have argued very effectively recently that we are in different times. That when interest rates are constrained by the zero nominal bound, discretionary fiscal policy can be efficacious as a stabilization policy tool. Indeed, they argue that under plausible assumptions, expansionary fiscal policies may actually reduce long-run debt burdens. And essentially, the argument is that crowding out occurs because when you run a large fiscal deficit, you've got a central bank which has already decided how much aggregate demand it wants in the economy. So when you run a larger funded fiscal deficit, the central bank says, no, you don't, I'm increasing the interest rate, which is pretty much what Paul Volcker did to Ronald Reagan in the face of the fiscal deficits of the early 1980s, i.e. there is a monetary policy offset to the fiscal policy stimulus. But if you know that you've got a central bank which has got interest rates at the zero bound, and has said that it is going to keep them there for the next 3 or 4 years, and has said that it is going to buy government bonds in limitless amounts until and unless unemployment goes below 6.5%, you no longer have that central bank-induced offset to the fiscal policy stimulus. And therefore, what is called the policy-relevant multiplier, fiscal multiplier, increases. I think that is a reasonably compelling case that DeLong and Summers have made. But the limit condition to this is what happens if you do it and your government debt to GDP starts going up to 200% of GDP, and even after all the things that you might want to net off, and I'll come back to those later, goes to 100% debt to GDP. So that in Japan, whereas I agree with Richard Koo that the fiscal deficits that the Japanese government ran were better than nothing in keeping the economy going, I can't see, and I've said this to Richard Koo, that he has any answer to the question, well, what are you going to do about the relentlessly rising fiscal deficits that arise from those? That may not be a problem if you're intending to increase your fiscal deficit when your debt stock is at a low level. In 1930, federal debt to GDP in the US was only 20%. Running extra deficits almost certainly didn't have a Ricardian equivalence effect then, because nobody was rationally worried about how you'd pay back those debts. But if you're a Japanese citizen and you're getting all the benefit of this fiscal deficit, you are simultaneously being bombarded with a set of messages that warn you that you're going to have to pay back all this debt, which accumulates a part of the deficit. So I think there is a reasonable case that whereas funded fiscal deficits will work in some cases, in other cases they are limited by debt sustainability concerns. Therefore, we have to think about whether there are any tools that get around that problem. And that's where you get to overt money-financed fiscal deficits. This is what Ben Bernanke said in 2003. He said, he was speaking about Japanese monetary policy, he said, what you ought to do is a tax cut for households and businesses that is explicitly coupled with incremental Bank of Japan purchases of government debt so that the tax cut is in effect financed by money creation. He said it would be important to be clear that much or all of the increase in the money stock is viewed as permanent, i.e. that there isn't an exit from this QE or a reversal. He said consumers and businesses will spend the tax cut since no current or future debt servicing burden has been created to imply future taxes, i.e. don't worry about Ricardian equivalence effects. And he said the debt-GDP ratio will fall because there will be no increase in nominal debt, but nominal GDP would rise owing to increased nominal spending. And while he basically suggested do a tax cut, he said, by the way, the same principle could also support spending programs to facilitate industrial restructuring. So in essence, he was saying there are two advantages of overt money finance. First, versus monetary credit support and macro pro-stimulus policies, they work directly. You're actually putting money into what Friedman calls the income stream. You can see where this benefit is going to come from. You know, you've had a tax cut. You've been employed to build this new road. It doesn't work through these somewhat mysterious portfolio and asset effects. But versus funded fiscal deficits, it's not offset by crowding out and Ricardian equivalence. And because it does those two things, it is essentially a combination of fiscal policy and of monetary policy. And it is, therefore, in a sense, distinct from quantitative easing, which is pure monetary policy, except it isn't quite as distinct as you might think. In the interest of time, I'm not going to run through the next bit of the argument, but I will simply give you a paradox that you will enjoy exploring, that quantitative easing in its classic form carries within it the contingent possibility that it will turn out post facto to have been overt monetary finance. Whereas overt monetary finance, which asserts in advance that it is going to be permanent, can be reversed if you want, because you could always run a surplus and drag money out of the economy, or you could mop up its effect by increasing reserve requirements on banks. So actually, when you look at it, there's a sort of all done by mirrors, a lack of complete distinction between classic QE and overt monetary finance. But they're still important in this respect. Overt monetary finance is associated with an overt increase in the fiscal deficit when you do it. QE is not. And overt monetary finance is associated with a statement that it's permanent. QE is typically associated with a statement that it will be reversed. And although neither of those statements really bind future policymakers, they may still manage expectations in an important way. So let's take it that overt monetary finance is fiscal and monetary policy combined, and it has those two advantages as a way of stimulating aggregate nominal demand over either pure monetary or pure funded fiscal. There are then two other things that I want to say about it in a technical sense. First, there is no more reason to believe that it is inflationary than any other policy lever. And to make that point, I return to the independence hypothesis I suggested earlier. If this stimulates aggregate nominal demand, the division of that aggregate nominal demand between prices and real output is unaffected by whether you achieve that increase in aggregate nominal demand by pulling this lever, this lever, this lever, or some combination of levers. There is no technical reason why overt money finance is any more inflationary than any other policy lever somebody proposes. And secondly, it's not hyperinflationary because it depends on the amount. If you did a helicopter money drop of £1 billion, there would be a very small impact on aggregate nominal demand and inflation. 10 billion, a bit more, 100 billion, a bit more, a trillion, and you'd have hyperinflation. A determined central bank and government together can certainly create hyperinflation, but they need to be determined to do it. And the key point I want to make there is what that establishes is there are no good technical arguments for excluding overt monetary finance from the available policy mix. There are no technical arguments for saying that this should be in the taboo box. But there are some important political economy arguments. The way to think about OMF, overt monetary finance, is that it's technically safe but politically dangerous. And Milton Friedman said the same in 1948. He said the proposal has, of course, dangers. Explicit control of the quantity of money by the government and the explicit creation of money to support actual government, expenditures may establish a climate favourable to irresponsible government action and to inflation. What he's essentially saying is, once we tell the populace and the popular press and the backbenches of Parliament that this is possible, they'll want to do it not only in the 1 year out of 100 when it's appropriate, and not only in a reasonable amount, but all the time in excessive amounts to try and win the next election. And that is the danger with it. Admitting the very possibility of overt monetary finance carries political economy risks. And that is why we have given OMF a taboo status. It's like a sort of veil of ignorance where we think it's impossible in order to make sure that we don't touch this bottle, which in small quantities is a useful medicine, and in large quantities is a fatal poison. And taboos can be useful constraints. Indeed, it's interesting that these taboos are so deep that you often find people essentially proposing overt monetary finance, but never quite using the word. So that overt monetary finance is the policy that dare not speak its name. If you look at what Michael Woodford said in August 2012, last year at Jackson Hole, he said optimal policy requires policy action that should stimulate spending immediately without relying too much on expectational channels. So not all that asset portfolio wealth effects. Let's just get straight in there. He said the most obvious source of a boost to aggregate demand that would not depend solely on expectational challenges is fiscal stimulus. And he said you need to be clear that some part of the increase in the base money is intended to be permanent. That's pretty much exactly what Ben Bernanke said in 2003. But if you read Michael Woodford's paper from Jackson Hole last year, you would not find him saying that I am saying the same as that he was saying the same as Ben Bernanke said in 2003. So we have a policy that dare not speak its name. But I believe we do need to break the taboo and accept the least possibility of considering the use of overt money finance in some circumstances. But I also believe that if we are to do that, we need to place it within the constraints of the disciplines and rules with which we have constrained other policy measures. And that gets to the issue of central bank independence. Now, central bank independence is sometimes seen as an absolute. But there's an extremely interesting article by Paul McCulley and Zoltan Pozar, and I think Paul McCulley is here. Paul, hello. There you are, which I extensively deal with in my lecture. Their argument is complicated and the charts are complicated, but let me give you a flavour of what they say to whet your appetite. They basically try to think about the relationship between what is happening in the private sector? Is it leveraging up or deleveraging down? What is happening in terms of fiscal policy? Is it austere surpluses or stimulative deficits? And what is happening to monetary policy? Is it following conventional policy or is it moving into an unorthodox space? And they say both the things that you worry about and the tools that you have to use will change according to where you are. When you have a big upswing of private debt, you're on this left-hand side, and you really ought to be worried about inflation. If the fiscal policy runs big deficits, you should be worried about crowding out because the central bank should respond. And in that area, they argue, the conventional rules that we have had on central bank independence and the tools that central banks use, broadly speaking, work. But that when you move onto the right-hand side and the private sector is deleveraging, there is a real danger that what you should be worried about is deflation risks. On the other hand, you don't have to worry about crowding out, and you need to worry about depression. So the fundamental framework says that both what central banks have done and will do, a positive statement, and what they should do, a normative statement, varies according to where we are in the cycle. And the cycle has varied a lot. This is an extremely interesting chart from McCulley and Polzer's paper, which shows what happened to private sector leverage in the US during the 20th century, way up in the 2020s and at the beginning of the Depression, then way down, then way up again, and what has happened to public sector leverage. Huge swings. And their argument, which I find very compelling, is that where we are in those swings makes an enormous difference to the policies that we have to use and to the appropriate constraints on central bank policy. And they then argue there can be conditions in which monetary policy has to go nuclear and has to go into the helicopter money space, which is overt money finance. And they argue that in order to do that, you have to have a degree of coordination between fiscal and monetary authorities, which is different from that which exists in the leveraging up cycle. And that is actually a point that Ben Bernanke made in his 2003 lecture. He said it's important to recognize that the role of an independent central bank is different in inflationary and deflationary environments. In the face of inflation, the virtue of an independent central bank is its ability to say no to the government, like Paul Volcker did in the early 80s. You can try running deficits, Mr. Reagan, but if you do, the real interest rate is just going to go up and up and up till you get disciplined. But in a liquidity trap, excessive money creation is unlikely to be the problem, and a more cooperative stance may be called for. But whereas a more cooperative stance is called for, I think it's crucial that we do not mean by that we should have no discipline whatsoever. I don't think we can move into an environment where we simply say the government decides the deficit and the central bank then funds whatever that deficit is. That is essentially what the US did during the Second World War, and that is acceptable as a wartime emergency act, but it's not a reasonable peacetime regime. And therefore, if we are to debate the potential use in extreme circumstances of overt monetary finance, we have to think about what rules we would use to constrain it. And I have three suggestions of rules. One is that it should be the absolute right of the central bank, in the UK, the Monetary Policy Authority, to decide what is the maximum amount of overt monetary finance that it considers compatible with any given inflation or other target. You can locate that decision in an MPC as much as you can locate an inflation target with an MPC. Or there is an idea which comes from Sam Britton that you could absolutely limit the amount of overt money finance you would ever do to the cyclical element of the deficit, not the structural element, as determined by an independent authority such as in the UK, the Office for Budget Responsibility. Or you could limit such operations to clearly one-off operations. You could say, I really do want
the banks to have not just slightly higher, but much higher capital ratios. Let's shock them. How about 20%? You've got 6 months to try and raise that money privately. And if you don't, I'm going to put in public money, which I'll subsequently sell off. But don't worry where that money's coming from. That's coming from money rather than debt finance. You could limit by the nature of what you do. I believe, therefore, it is possible to wrap OMF round with the rules and disciplines which would be essential to make sure that this medicine doesn't go into a poison. I also think that we know from economic history that there are some times when overt money finance is the right thing to do and maybe the only thing which can achieve the stimulation you want. If Herbert Hoover had known that overt money finance of an increased fiscal deficit was a possible option in 1931, the US Great Depression would not have been as bad. More importantly, if Chancellor Brüning had known in 1931 that it was possible, the history of Germany and Europe in the 1930s would have been less awful. Remember that the Nazis got 2.6% of the vote in 1928, and that their increase from 2.6% in 1928 to 37% in 1932 was not in a period of hyperinflation, but in a period of rapid deflation. Deflationary risks are as important as inflationary. And I believe that Bernanke was right, that Japan should, 10 or 15 years ago, have done an overt money finance tax cut or public expenditure increase, and that if it had done so, it would now have a somewhat higher level of money GDP, a somewhat higher price level, a somewhat higher real output level, and a lower debt to GDP. Now, there are some other cases where you may not need to use overt money finance, but even in those, I think we should consider whether it would be better or worse than alternatives. So consider the options set out here. Option one is you do several hundred billions of QE with a commitment, which of course you don't absolutely need to stick to, but you are committing at the moment that you're going to do a future reversal of it. You do a funding for lending scheme, you relax bank capital and liquidity standards. May be effective, but may be subject to the limits to the effectiveness or the adverse side effects later, which I set out earlier. Or you do several tens of billions, much smaller, of overt money finance of increased fiscal deficit, tax cuts or public spending, with a commitment that this will be permanent. Which of these two options will be most effective in stimulating nominal demand and have the least adverse side effects? I do not know, and the decision on that should be subject to deep empirical analysis by people thinking through as best possible with the best possible models the first order and second order and third order effects. So I don't know the answer, but I do suggest that we should at least ask the question. Now, I have some comments on the implications of all this by country and currency zone, but I'm not going to go through them except to just read out on this chart. For Japan, Bernanke was right. For the US, the current policy mix may well be optimal. It may well turn out post facto to have been money finance, permanent money finance. It may turn out to be, as it were, PMF but not OMF, permanent but not overt. But do we need to say so, or would saying so just upset the political dynamics? In the Eurozone, optimal policy is blocked by incomplete currency union. And in the UK, unfortunately, which is to raise another issue, supply constraints may be as important as demand. Just for the UK, look at these figures. The breakdown of the increase in nominal GDP since the trough of 2009. Plus 10.4% in the UK, plus 12% in the US, plus 7.1% in the Eurozone. Where did that go between increase in prices and increase in real output? UK, plus 8%, plus 2%. US, plus 5%, plus 6%. Express that as a proportion. The proportion of our increase in aggregate nominal demand, which went into prices, not real output, was the worst of each of those three zones. What that suggests is that we need to be a little bit careful in the UK of assuming that the only problem is how to increase aggregate nominal demand, we may need to think through in the UK, can we do anything clever in policy to make sure that we skew the result towards the real output box, not the price box. So, conclusions, here they are. Leverage and the credit cycle matter a lot. Banks are different, arguments for free markets don't apply. Excess leverage crises are followed by attempted deleveraging, which changes appropriate macro demand policy. In the deleveraging cycle, monetary, credit support and macro prude levers may at the limit become powerless and may have adverse side effects. Fiscal multipliers are higher when interest rates are at the zero lower bound, but long-term debt sustainability is still something we have to worry about. Governments and central banks together never run out of ammo. OMF is possible and may have less adverse side effects, and in technical terms is no more inflationary than any other levers. But the political economy risks of OMF are huge. So we need strong disciplines to constrain misuse. Overt money finance should not be a taboo subject. Finally then, to the issue of Mephistopheles, money and debt. You may remember that Jens Weidmann said that all this activity degenerates into inflation, destroying the monetary system because the money rapidly loses its value. But his interpretation of Faust Part 2 has been challenged, and challenged by somebody who speaks with a great deal of authority. Professor Harold James of Princeton University is one of the finest economic historians in the world, and he is a particular expert on German interwar economics. His book on the German slump is one of the great classics of German economic history. He is also, as it happens, half German, and he speaks German fluently, and he is steeped in the knowledge of German literature and language. And his take on Faust Part 2 is a little bit different. He describes Mephistopheles' temptation, and then he says, what happens? Everything in the empire improves as a consequence of the introduction of paper money. The generals are pleased because the soldiers are paid once more. The treasurer finds that he can pay off all the debts. Tailors are busy making new clothes. Ladies become more willing to embark on well-paid romantic adventures, and the property market booms. So that while there are some undoubtedly subsequent consequences which in the wake of our own crisis we would recognize as warning signs, such as the property market booms and simpletons can buy big houses, the potential benefits of paper money cannot be ignored. So who's right, Weidmann or James? Well, of course, in reality, the differences in their interpretation are less than first appear. Both refer to the beneficial effects of modest money creation, both to the dangers of inflation when money is created in excess. I think that leads us clearly to James's conclusion that a well-managed paper currency, or one would say today electronic currency, could offer greater price stability than gold or silver-based economies, currencies, while also serving the needs of a potentially expanding economy. Money, in its pure fiat, irredeemable base money form, is a powerful economic medicine if used within tight constraints, but a potential poison if used to excess. As for debt contracts between private sector agents and in particular bank loans, which create matching bank credit and money, well, they're not mentioned in Goethe's Faust Part 2, but as the great economists of the 1930s, such as Fisher and Simons correctly pointed out, uncontrolled creation of bank credit and money can be a major driver of financial instability and subsequent economic harm, and can be so even when the creation of irredeemable fiat money seems to be tightly controlled, with fiscal deficits small and central banks following and achieving inflation targets. And I think that drives us to two conclusions. First, that in the deflationary, deleveraging downswing of the economic cycle, we may need to be just a little bit more relaxed about the creation within disciplined limits of additional irredeemable fiat-based money. But second, that in the upswing of the cycle, we should have been massively more worried than we were pre-crisis about the excessive creation of private debt and private money, and that we should be somewhat wary of relying on a resurgence of private debt and leverage as our primary means of escape from the mess into which excessive debt creation got us. Thank you very much.